Phew. All right, on to a lighter note. So this is probably a video that I told you guys I was going to make about quantitative easing. I took a poll out. Sorry, I was trying to get all my facts right and really try to explain it to somebody who probably doesn't know much about like the money process and stuff, right? So essentially, the Federal Reserve was created in 1913. When I was growing up, I was like, definitely it's a conspiracy theory. The way it was made on Jekyll Island, and it's a privately held company, and there's some people that own stock in the company, and they still get paid off of printing our money. Huge conspiracy thing, but as I'm getting older and older, and investing in stuff and all that, their policies and their power that we give them, it works really really well hand in hand, with the economy, and I think they're finally starting to flex it. So basically, the Federal Reserve was created to stop bank runs in a sense, and it was to control the money to control the money supply. So a quick breakdown. Before 1913, there was a bunch of bank runs, and then the Federal Reserve was established. There was actually like the first Bank of America, or so there was another bank that acted like the Federal Reserve back before, like in 18 something, but it didn't really stop anything. Either way, there were still a bunch of these banks, and after the panic happened in the early 1900s again, like there was bank runs where people were like, "Oh, we're going to take our money out." And this is before we had FDIC insurance that said, "Hey, don't worry, we will insure your each bank account up to $250,000,000," right? So essentially, the Federal Reserve was made, and it was there to stabilize prices and to maximize employment. That's their goal in a sense, right? So when an economy slows, the Federal Reserve can step in with monetary policy. They can control like the interest rates, and they could fluctuate those by saying, we're going to offer this much cash to banks if they park it at our bank, and they could quite possibly theoretically drive that negative, so it forces banks to lend any money that they have to kind of prop up the economy. So where quantitative easing comes in, which is QE. This was their new design. It's been going on for about a decade now. So the Federal Reserve injects cash digitally. They just hit a number and boom, cash is injected. They create the cash on their balance sheet, and they use it for open market operations. So open market operations just means a fancy way of saying that they're going to go out there and buy a bunch of crap from the public market. So what do they buy? They buy U.S. Treasury bills, and then they usually, in the housing crisis, they bought the mortgage-backed securities. All the bad loans that the banks had, they came in behind and bought those out. And it's kind of weird. It's kind of like a virtual like hole. Like you created money, the money came in and bought a bunch of stuff that nobody wanted, a bunch of stocks nobody wanted, and they put it back in this hole, and it's removed from the economy. But at the same time, if I owned that bad asset, now I got the cash. So it hasn't really gone to the regular people. That's how they've been able to keep inflation down, is because, I'm getting off topic here, but it's kind of like there's a cotillion effect. That's from my research and understanding so far what's really going on in a sense. And so think of it this way: me and you and two other people were playing Monopoly, right? And we got all of our properties up and this and that, and everyone's down towards the end of the game, right? Like, so it's me, I'm the winner because I'm a badass, and I got all the properties, I'm making all the money, and three other people are just kind of wallowing around until they go broke on me, right? And then we have a banker, obviously. So think of the Federal Reserve as the banker. So the Federal Reserve, what the Federal Reserve will do is they'll come up and they'll say, "Hey, let me buy your blues and or your browns, and we'll pay you, let's just say hypothetically, 5x the value of it." So if the value of the property was 100, they're going to pay me 500. I'm like, all right, great, cool. I take that cash. I have it now. And then they also say, "Hey, to all you other three players, we're going to keep this game going. So here, we're going to throw some money for you to bail you out, pull the money to you, pull the money to you." So now everyone has money. And then the game just keeps going. That, in a sense, is what's happening in the stock market. And that's why the stock market's not really correlating with what the reality is. So, in effect, quantitative easing is really just doing that. It's putting a lot of money in the hands of few people. And that's why inflation hasn't been able to just run rampant when they've injected $7 trillion, is because it's really going to major institutions, and they have no place to put it. So they just go out and they buy more stocks, and that's how the market just keeps going up. And if you start understanding this, then you realize, wow, that's why there's a big drift between the stock market and the regular market. And I got some more facts that are going to blow your mind when we talk about who really controls market. But so let's say, why do the quantitative easing, right? Why digitally print money on a balance sheet, go out and buy stuff? Well, they do this because they want to lower the cost of borrowing, right? Because essentially, if they buy all the banks' bad assets, like if they buy all the mortgages back from the banks and they buy all, their bonds that they're holding from the banks, right? So if I'm the Federal Reserve and this is, Chase Bank and Wells Fargo, we'll just use Chase Bank and Wells Fargo, and like Wells Fargo wrote you a loan, they're like, oh shit, you're not going to pay, it's a bad loan. Chase Bank wrote you a loan, like, oh shit, you're not going to pay, it's a bad loan. I'm the Federal Reserve. I said, give me those bad loans. Boom, and here's all your money. Take it. Get out of here. So they have all this cash. And then I turn around and I tell them, hey, you have all this cash on your hand, but you can't you can't park it at the Federal Reserve. I'm only going to give you, hypothetically, let's just say 1%. And they're like, well, shit, we're sitting all this cash. I can't make any money on this cash. What am I going to do? All right, well, maybe I'll loan it out to you to start a bakery, or to you to buy a new farm, or you to buy a new apartment complex. And then you could see theoretically how they could get the economy pumping as they put the money there. Now, that's one of the flaws of QE, though, is they can't force these banks that they're, and there's a lot of these banks that are in the circle, they can't force these guys to go spend money, because these guys are still like, well, we don't know. That's one of the bigger problems here. But essentially, it would, free up, it would put more cash in and free it up and allow it to spend more. The economy would prop up. And that's the theory behind quantitative easing. But we just talked about why when it's not always the greatest things, because these banks could hold a lot of cash and they could be, well, I'm not going to rent to your bakery. How do I know your bakery is going to work? Blah, blah, blah. So it could be slow to get that capital to regular people. So just recently, the Fed said, screw it. We're going to take it above, a little bit above it. They started buying up stocks and more securities. So they're like, well, this is the only way in the public that they could do it. So think of like the trickle effect, right? So like, well, fuck, this company's about to go broke or something bad's going to happen. We'll just buy out all their stock, or buy out a lot of it in the open markets, and buy out their bonds. We'll give them the cash, and hopefully they inject the cash back into their business or into another way to help employment, right? Because unfortunately, as of right now, there's no tool for the Federal Reserve to just go to me and you and give us a direct loan that says, oh, you have a great idea for whatever, screw it, we'll take a gamble on it. It's just not the way the system is set up. So to wrap it up, quantitative easing is a policy where the Federal Reserve creates money out of thin air. They go use that money and they buy stocks and bonds and treasury bills in the open market. And the idea behind it is by them doing that, and then where does this money go, right? So they buy these bonds, they buy these stocks, they buy everything. Like, oh, I want all the water, and they got everything. They hold it, and then they say, we're going to leave it on a balance sheet. But eventually, one day or later, they need to de-lever that balance sheet. And it started happening a year ago before all this happened. But they were only de-levering like such a minute amount. I mean, they had like $7 trillion plus, and they were giving away, or they were only selling or destroying like $50 billion. And they have to be careful, because essentially what happens, the theory behind it is either they delete it, which honestly, I don't know what would happen if they just delete it, if they just snapped their fingers and said, that's gone. Maybe that's a solution. Who knows how that would fluctuate with, I got to do more research on that. But theoretically, the one way I do know how they delever is they would sell it back into the market, and then they would, eventually, slowly but surely unwind that balance sheet and bring everything back down to normal. Because the theory is when the economy goes down, then the Federal Reserve uses quantitative easing to buy all the bad assets. They put money in. So, people have cash, or institutions have cash. The institutions start lending, and then the economy comes back up. When the economy comes back up, then they start selling some of those assets back to the market, and then we get a balance. That's how it's supposed to work. But the flaw is, can't force banks to lend, right? So, QE also helps with governments. They also can spend more. That's why our debt's being able to rack up. Why? Because if the Federal Reserve is offering, let's say 1% on debt for creating new money, and they're willing to buy government treasury bonds or whatever, then the Treasury could say, well, they're only offering 1%. Well, then how about we offer the public, 1.2%? You know what I mean? So they can print a lot more money at a cheaper rate. You're not really holding the government accountable for, charging a fair rate for their Treasury bonds. So they could, and then you always have someone that's willing to buy it. So that's why this debt's being able to get racked up. So none of this money ever really affects the real economy because people like me and you only have access to that cash if we have access to the banks or if our boss has access to those banks. And then they take the gamble and then we start. So it's really they've been able to magically bottle up inflation because the amount of money that they printed, this shit should go, through the roof. Everything should be costing, at least 3 to 4 times as much, So that's the one issue that I'm having is how long can they hold this and the theory here is it's not going to be inflation. Because the thing is, you can't do QE forever, right? It's just there's a certain point where it could lead to inflation, right? And but the one thing is, I think it could lead to a deflationary period where your money is actually worth more. And why is that? Because if banks decide not to lend because they're scared to death of the economic certainty, and even though they have all the cash, but why would they want to put themselves in a risk and take on risk in a market like right now where they're like, I don't know if maybe starting a new nightclub is the best idea or whatever have you, right? So if they start hoarding the cash and they have all the cash, but the people like me and you that need the cash to go do stuff, it's less because the actual physical supply of money is less because there's only banks and institutions hoarding it. Then that makes the dollar in our smaller economy go up. You know what I mean? So it causes so if the dollar is worth more, then the prices that are like of farms and of houses and of cars and everything are going to go down, right? And you're like, well, how does that work? Because, okay, if there's less money, if we're all fighting for like $5, that $5 is going to be more valuable, right? Versus if there's $5 million, then we don't really care about $5, right? So if everyone has money, then everyone could buy a house, everyone could buy a car, we'll pay whatever, who cares, let it run. But if the banks aren't lending and me and you can't have access to money, we only have the money that me and you have, and we want to go buy a house and we want to go buy something, it makes it a lot harder, right? Because now you have to lower your price because not everyone has $100,000 to buy your house. Maybe I have 90,000. I'll pay you 90 or 80. So it causes prices to go down. So that's also a battle that could happen. Real quick, I got a couple minutes left in the video. So I just want to say this, that number one, there's like 2,800 publicly traded companies. There's 23 million small businesses. Number two, market is a fraction of the real economy, as you could see. 2,800 publicly traded companies, 23 million small businesses plus. It might be a lot higher than that. Number three, there's only 12 to 15 institutions that control the market. Let's take BlackRock, for example. They manage 7.3 million in assets. So that represents 148 million people having $50,000. The average person has $50,000 in the stock market. BlackRock, as being one institution alone, would represent the price action of 148 million people. So when you see the market rallying and going up, it's not because regular people like me and you are buying into the stock market. It's these institutions that are backing the money in. There's a huge correlation between the stock market and regular people. And you can make money in the stock market even when regular people and lives are struggling because all these 12 to 15 institutions have all the power. They get to dictate what the price is. They get to dictate almost everything when it comes to the market because they own the most security. So they go in and bid up the price on something. They're going to make the price go up. On paper, they're going to make more money. So it just, things are wild, man. Things are a little bit wild right now, and you got to place your bets accordingly, okay? Hey, I hope this video helped. I hope you learned something from it. And if I talked too fast or didn't explain something well enough, hey, drop it in the comment, and I'll try to DM you or I'll try to make another video to correct it or to follow up, okay? And, oh yeah, if you can share this with one person, that'd be freaking great to help me grow the account.